Hi, it's David again. Are you the CEO, CFO, or board member with oversight of a company's financial statements? Did you know that being associated with financial statement fraud could lose you your job, your career, and personal goodwill, but you could also be charged criminally? In the next 10 minutes, I'm going to provide you with a high-level understanding of financial statement fraud, some typical fraud schemes, and red flags for those of you who want to know what it looks like if it's coming your way. My name is David Malamed, and I am a forensic accountant and fraud investigation expert. What you learn in this video, you will be able to use right away. So let's go. What is financial statement fraud? Well, financial statement fraud is the deliberate misrepresentation, omission, or misstatement of financial information from the financial statements for the specific purpose of misleading the reader and creating a false impression of an organization's financial position. Companies and leadership would want to manipulate financial statements for many reasons, such as securing performance bonuses, influencing investors, and manipulating stock prices. While the size of financial statement fraud can be large, actually extremely large, think Enron, WorldCom, and Parmalat, the ways in which the fraud occurs is actually rather limited. Usually, manipulation involves a company reporting they sold more than they did, which increases profits, or they report that they spent less than they did, again increasing profits. All of these consequences can have a dire impact on the innocent counterparties involved. From my experience, such fraud is not always committed for personal gain. Fraud is often initially committed to mask the true position of a struggling business, only to have the fraud actually spiral out of control. The perpetrators tell themselves that they're going to fix it next month or next quarter, but they're never able to do it. The fraud spiral is often powered by what I call the costs of fraud. Let me give you an example. Taxes owing on fraudulent gains, dividends to be paid to unsuspecting investors, or interest to be paid to either source the debt or for the acquisition of another business to help camouflage the actual fraud. But more on the costs of fraud later. Let's recap. Conducting financial fraud has a limited variety of techniques, but one of the most common is the overstatement of revenue. There are numerous ways this may be done, all of which can be fairly simple to implement, yet have an enormous effect. If financial statement fraud is to remain covered and masked, a fraudster will usually need to implement a fake trading scheme, which is fairly easy to establish by following a few simple steps. Number 1, incorporate unrelated and independent counterparties in jurisdictions outside the company's main jurisdiction. Then, appoint unrelated friends, family, or colleagues as directors and shareholders, and generate invoices reflecting fake transactions with the new counterparties, both for sales and purchases. A fraudulent trading scheme uses a series of controlled companies as suppliers and customers, enabling a legitimate route for cash to be funneled out of the company, usually at the expense of financiers through the provision of trade finance and term loans. Lesson number 2. While fake purchases lower profit, they are an essential part of the fraudulent trading scheme, as payment of fake supplier invoices enables money to leave the company. Of course, overstating revenues from a fake trading scheme is not the only way to commit financial statement fraud. Understanding expenses is just as important when it comes to inflating profits. Capitalizing expenses, For example, converting expenses and cost of goods sold to, say, a loan receivable is one way to achieve this. Sometimes the government even allows this in its accounting rules, and it can be a good thing for large companies like Google and Microsoft, but disastrous for a small company. If you are considering investing in a small technology company, look out for this. Government accounting rules allow you to capitalize investments in the development of technology like software. Software development is a people-driven process where the costs are almost 100% salaries. Accounting rules say, I can take my investment in software development and capitalize it, not expense the salaries associated with that development. The cash in the business is gone because it's been paid salaries, but the expense is only partially taken in the first year. You know what this results in? It results in much higher profitability. This is fine as long as the company is generating significant amounts of cash to cover the cash shortfall. In a small company, this is unlikely and means that unless the company is able to find new sources of funding, they won't be able to survive. If you are considering being that new source of funding, beware of this when you look at the company profitability. Alternatively, the use of a buying agent, being related parties acting on the company's behalf to purchase stock and sell the products, can be used to the same effect. The added benefit of this approach is it serves to understate a company's liabilities by not disclosing all of them in the form of accounts payable, and therefore it improves the apparent health of the company. Let me give you an example. WorldCom mastered this technique, understating expenses by approximately $3.8 billion. Purchasing fixed assets at an inflated price from an intermediary or connected party is one way to overstate the size of a business. Similar to fake purchases in a false trading scheme, it is also a way to funnel cash out of a business to an unrelated party at a markup on the real cost of the assets. Of course, a fraud can only be perpetrated for so long before stakeholders might become suspicious. One solution I have encountered on numerous occasions to counter this is covering it up by acquisition. For example, the purchase of a healthy, performing company masks the underperforming original business and the associated fraud. Given the usual ready supply of fresh equity and debt, the fraudulent business is able to retract with its fraudulent performance. Acquisition becomes a logical step, and often at inflated prices. Financial fraud is a serious white-collar crime that often comes with heavy punishment and fines, but the details of the misdeeds can be stranger than fiction. Recently, numerous charges of fraud and alleged fraud have made headlines. Financial statement fraud isn't new, and the extent of the crime can vary significantly. In some cases, billions of dollars are lost and companies end up bankrupt. Most cases, at least public cases, have at least one person, but often a group of fraudsters, going to prison. Some cases involve forged documents, while others focus on trying to sell an item somebody doesn't own. Ponzi schemes are also common. Even Bitcoin has been the source of fraud. We've dealt with companies who have dealt with criminal charges, ceased trade orders, other regulatory requirements, and allegations of financial statement fraud. If you feel you're in the middle of what may be a fraudulent storm, connect with me and I will help you navigate to port. We know these are not issues you want to deal with ever, but if you do, we can help. To find out more about me and the services we offer, please visit uncoverfraud.com. Lesson 3. Buying a real business is often used to hide the existence of a fake business. Paramount to a fraud enduring is surviving the annual audit. A few easy steps, however, makes this fairly routine. So, postal addresses for companies involved in the fraudulent trading scheme need to be controlled by the fraudsters to facilitate the completion of the obligatory confirmation letters for creditor and debtor balances. The more remote the locations that are used to hold inventory, the less likely stock takes will occur. However, we've all encountered occasions of fraudulent companies having fake inventory on consignment, rotating inventory between sites, and even borrowing inventory to survive such inconveniences. Timing repayments from fake debtors to satisfy subsequent receipt testing is also a wise move for the fraudster on top of their game. For the lazier fraudster, journal entries from more highly scrutinized balances, such as accounts payable and accounts receivable, to catch all such accounts as other assets and other liabilities is a helpful approach during the year, as auditors don't really look at inter-year movements. Similarly, as some of the largest frauds conducted have evidenced, if moving cash between accounts is not sufficient to pump up year-end balances, forging bank statements can be just as effective, given so many audits are not executed as planned. Again, when Parmalat collapsed, it admitted that $3.9 billion of cash simply did not exist. Unfortunately, this has become all too common, with new schemes emerging all the time, the latest being reverse factoring. There have also been occasions in China where auditors have attended banks to verify the bank balances, only to be met by personnel pretending to be bank staff. Lesson 4. Don't only trust audited accounts. Ever. If I can't trust audited reports solely, what can you do? Well, if your money is at risk, do your own due diligence. If there is a lot of your money at risk, hire someone who can do the work for you. The cash trap problem with fraud, other than being immoral and illegal, is that it is an expensive thing to do. Remember we spoke about the costs of fraud? We actually touched on the concept, but let's explain it a little further. A common motive to engaging in financial statement fraud is to make the business appear more profitable than it actually is. This helps improve share prices, meets covenants, earns bonuses, and increases the value of a business if it's being sold. Many businesses engaging in financial statement fraud are actually incurring losses. And so for a company that's incurring losses but reporting profits, they need to fund those losses, and that's where the debt-funded fraud comes into it. But it doesn't stop there. There are unavoidable consequences of reporting profits while actually incurring losses. The first is the taxman. If you report profits, the taxman wants their share of them. And for companies that are actually incurring losses, they need to be able to fund those tax payments. Shareholders also expect dividends when the company is reporting profits on a regular basis. And this is another cost, a real cost, that the company will need to fund. And with all that debt being incurred, including the conduct of the fraudulent trading scheme, the company's interest cost will be going through the roof. Yet, another cost of fraud to fund it is funding it with more fraud and financed by more debt that ultimately just makes the problem worse and worse. And this is a fundamental part of why losses to financiers are so large when these companies collapse. Huge amounts of debt have been used just to fund interest, dividends, taxes, and real operating losses rather than any theft by the fraudsters themselves, although they may profit through their share of dividends paid. And finally, lesson 5, the cost of fraud. Fraud needs to be funded by even more debt or equity sales, and leads to even greater losses for creditors, most of which cannot be recovered after the company collapses. And this brings us to the other issue involving cash flow and companies engaging in financial statement fraud. While it's relatively easy to overstate profit, it's much harder to overstate operating cash flow. When you are risking your money, your reputation, this is the metric you should focus on. This is the metric that will tell you the likelihood that your money can be repaid. There is a high incidence of companies that conduct fraud reporting positive and improving profitability while actually incurring losses, but also reporting negative operating cash flow. This is because while cash used to fund the fraudulent trading scheme can help improve operating cash flow, over time, the real cash needed to fund the costs of fraud will restrict the extent of cash available to fund the fraudulent trading scheme. And so, the fraudster must undertake more fraud to get more financing to meet the costs of fraud. The problem snowballs. Hence, why the company collapses, or conducts a large acquisition to try and gain access to more cash and then collapses, or starts to sell off assets to gain access to more cash and then collapses. Faking profit is relatively easy. Faking operating cash flow is much harder, but that's another video. My name is David Malamed, and I am a forensic accounting and fraud investigation expert. To find out more about me and the services we offer, please visit uncoverfraud.com. If you found this video helpful, please don't forget to like below, subscribe, and leave me some comments as well. God bless.